So, are you looking to get in a home and you want to try to get in the easiest way you can, but you don't have good credit, you don't have the means to getting an FHA or conventional or VA loan, but you think owner finance and wraparound, maybe contract for deed is easier? Well, in some cases, they are easier because there's no credit check. It's just have the money and walk in the home. But there is some due diligence things that you want to do to safeguard yourself because owner finance can be a double edged sword. If you have a seller who still has a mortgage on the house, they have to still keep up that payment. And the other thing is when you're making payments to that seller, you want to document where those payments are going to. So there are different things that you want to do. And at the bottom, if you look at the paragraph and read it, you'll know there's such awareness on what you need to do when you're doing an owner finance or wraparound or contract for deed. They're basically all the same. The difference is that the owner finance is there's no loan on the home. The wraparound is because it is an actual mortgage on the home and they're wrapping a mortgage around that. And the contract for deed is similar to that wraparound mortgage. So either way, these are easier ways to get into a home, but there is a lot of risk on the buyer side. So you do want to make sure you read this paragraph, understand your rights, and get into talking to attorneys, talking to title companies, understanding where you're at. Because just walking in a home, putting money down, getting keys is one of the worst things you can do if you don't know what you're doing. And you can lose a lot of money, lose the house, be moved out of your house, kicked out of your house that you thought you were buying because it really wasn't your home. It was still the sellers. They just weren't making the payments. So it's very, very risky. You want to be very careful when you're doing things like this. So hopefully this opens your eyes, this paragraph, and gives you a lot of great information so that you're prepared if that's the direction you want to go. The other thing to remember also when you're doing these type of mortgages, the down payments are severely more expensive. They're anywhere from 10 to 20, 25% down, whatever the seller's requiring. And the interest rates are a lot higher. So you got to be prepared for that because that is something, it's like, you just put it this way, you're doing a non-traditional mortgage and these sellers have to take a chance with you. So yes, they're going to be more expensive. You're going to put a lot more money down and you're going to pay a higher interest rate. So read the paragraph at the bottom. If you have any questions, reach out to me. But this is very great information to understand so you know before you get into the situation what to do. Okay. So anyway, reach out to me at the bottom. There's a red link that says contact me if you want more information and guidance, and you can reach me there at any time. Have a wonderful day. Talk to you soon. Bye bye.